Welcome back to FoxNews.com Live's Business Hour. I'm Diane Maceda in for Tracy Burns right now. And I'm joined now by Stan Dash, the analyst for TradeStation. And Stan, you know, we're talking about the debt ceiling, and we were talking about how the markets are tanking, but something that's not tanking right now is gold. I mean, it's been hitting records almost every day this week. And I'm curious about that because, you know, we saw the debt ceiling issue resolved. They raised it. And you would expect to see the markets going up. They're not. They're going down. Yeah. And gold is still hitting a record high, which usually means people are looking for a safe haven.
It was this morning anyway.
So why don't we talk a little bit about the relationship there and how that's working out?
Sure. We saw a good rise up in gold when the debate was going on in Washington, and we were waiting on each announcement and each press conference from the legislature and of course from the White House. We had a nice move up in gold. We made new highs this morning. Before I left my office, we had made a high of about 1685, so we're getting close to that 1700 area. Now we're seeing a big liquidation in a lot of these markets. That turned around. Silver turned to the downside. Crude oil has been very weak today. It was a little over $88 a barrel the last I looked before I came in. So we're seeing now an across-the-board sell-off, it would seem, in those major commodities.
Seems like in everything.
That's right.
Except maybe Treasuries.
Except Treasuries. Well, that's the interesting part, because now why are we in Treasuries, and why were Treasuries rallying so strongly if we were so worried about U.S. debt? If we were worried about a U.S. default or a downgrade? The Treasury market was probably the most reliable market throughout that period.
Right.
You know, markets couple and decouple. They connect and then disconnect. I think it kind of sounds like the freshman class in college. But, now we're at one of those points where the connections are getting a little scrambled again. So we have to be a little patient. We have to try and see our way through it a little bit. But the connections aren't particularly clear. For instance, today it would make sense that gold was up. We certainly don't know what's going on with Europe, which we can talk about a little bit, and U.S., GDP, labor, which is what you've been talking about. But at the same time, we're now seeing this broad liquidation, as we said, in commodity prices, including silver, crude oil, and in gold.
Well, and you were talking about the Treasuries earlier. I mean, we literally saw as the debt ceiling was raised, Treasuries spiked.
Well, Treasuries were going up even when it looked like it might not be a deal.
Right. So, I mean, but that makes sense that people would be nervous about that, so they're going to the Treasuries. But
well, they're obviously confident that there would be some
right,
kind of deal,
and then it was raised, and they went up.
Yeah.
You know, it seems like like investors aren't sure whether they should pay attention to the economic reports or what's going on in D.C.
Well, I think one of the things about the Treasury market is it probably still tells us, despite all our problems here and the globalization of some of the problems, is that the U.S. and U.S. Treasuries are still the safest assets. I was looking this morning, the 10-year notes are about a 2.5% yield. 2.5% for 10 years. In some ways, people say that's a matter of putting your money in just to hope you get it back,
right?
and have it safe in that sense. I don't know what the purchasing power might be 10 years from now, but at least you have the confidence that the U.S. government is going to be there. So there's a large expression, I think, around the world that the U.S. government is still going to live up to its debt. When we see equity prices and asset prices fall like this, the broader question becomes, yes, but, and the but being, what will the economy look like?
Well, and the other relationship that seems kind of skewed is the dollar versus commodities. Normally, when the dollar goes up, you see dollar-traded commodities like oil and gold go down. Yeah. And that pattern has been completely skewed over the course of the past week or even more.
It's very dramatic today.
Absolutely.
With a sharp rise.
Why that disconnect?
In the dollar? Well, I think it's one of those decouplings that we're starting to see between these prices. There are some points at which markets can no longer carry through on the same story. They become less compelling. Just like any asset we might buy at one price, we might not buy at a higher price.
Right.
And so that disconnection is coming a little bit because central banks are getting involved now. We certainly saw action from Japan, and we certainly saw Trichet this morning from the ECB talking about possible changes in policy in Europe, questions about Italy. So the market suddenly starts to say, well, how do we price? And I say the market as if the market is the amalgam of all of us. Yeah.
Right.
But how do we price? And that's the uncertainty. I think that's why this has such an intensity to it this week, is how do we price?
Well, and it's interesting to see it react with such an intensity when they actually didn't. Both the Bank of England and the ECB didn't actually raise interest rates, but just on the idea that they might in the future.
Right. I spoke with one colleague today who was saying, well, if the ECB needs to lower rates, then I suppose that's the right policy. But how does it make them look, considering the last move was to raise rates?
Right.
So now we're trying to outthink the policy of the policy. But as I said, that's why I think there's such intensity, because as investors and traders, we know that at times we're going to be wrong. But we at least like to have a sense that we made an analysis and it could come out right, and maybe it won't come out right.
At least you understand the game. Sometimes, you get caught on the river, but at least you get the game.
Right.
And now it seems like people aren't so sure they get it.
I think that's why I use that coupling, decoupling analogy, and we have to be a little bit patient. We have to consider the risks that are in front of us, and we have to pay attention. And
talk about Europe a little bit. How does that fold into this mix? Aside from obviously the banks we discussed a little bit, but just the overall debt crisis, that's saying Italy might be in trouble, Spain might be in trouble. Yeah. How does this affect, it's all one big market, it seems. Anymore? So, yeah, exactly.
It's a very interesting situation if you look at it strictly academically in Europe, that there are sovereign nations that are all sharing a currency and a central bank. And usually what a country would do might be to reflate its way out of a economic problem. It might be to, in control of money supply and interest rates, just as we do here or the Bank of England would do. But now we're dealing with a European central bank that has very different economies, different social policies, different spending policies, different tax policies, and yet they share a common currency. So a country can't decide to, within the European Union, can't decide to change its policies in order to influence the value of its currency, because it shares that currency with so many other countries. That's what makes this unique, and that's why we've been talking for quite a while about, especially in relation to Greece when it was coming up, this being the first real test of the euro. Yeah, that's right. So far, I think actually they've probably handled it pretty admirably and shown a commitment to what they started years ago. But it will have to work its way around, and there probably will have to be some longer-term changes in the way they handle both the sovereign aspects and then the EU aspects.
Right. Well, but there are a number of people that think that they should have let Greece go into default and should basically force Greece out of the EU to do exactly what you just said, and then come back in a few years when you're doing better. And at what point does it start to have a negative effect on all of the countries? Germany can't support the entirety of the continent of Europe.
That's true. But Germany, France, and some of the Scandinavian
France
countries,
has already come out saying that they took a big hit with Greece. Yeah. What happens if Italy starts to fall and Spain starts to fall? They can't do it all.
I think that the large economies within Europe probably have to realize that doing that would probably be more of a negative, because what hit would their banks take? What hit would investors take in their country? What would that say for the stability and their full faith and credit, just as we've been discussing with the U.S., if they would let that happen? The question is, can they impose measures across borders? Will the members of the EU agree to give up a little bit of that sovereignty to have a central bank?
Right.
I think we can probably say pretty without an argument that the EU has been a success in that it has brought economic growth to Europe and has unified Europe, and the question is, will it persist that way?
We'll have to see whether or not they survive this test.
Yeah.
Well, thank you so much for being on, Stan. It was a pleasure.
Sure, thank you.